Asian markets were jittery on Thursday following Wednesday's sell-off in the US. The Hang Seng Index in Hong Kong slid by 0.5%, but the mainland China composite crawled up 0.29% off the back of stronger than expected services growth for July. Meanwhile, on Wall Street, tech stocks led losses, with the tech-heavy Nasdaq dropping more than 2%. Markets are still digesting the downgrading of US debt from AAA to AA+ by ratings agency Fitch, which warned of the risks of further deadlocks in Congress over the US government's borrowing authority. Let's get more on this now with Han Tan in Abu Dhabi. He's Chief Market Analyst at Xinity Group. Hi there, Han. Many analysts said investors would be shrugging off this downgrade, but we're seeing the sell-off continue. Can we expect a longer-term fallout?
In terms of what can and should be directly attributed to the Fitch downgrade, I'd say not much, right? So I think the sell-off that we're seeing yesterday was due to rising treasury yields as more US treasuries are expected to come online over the coming months. And to be clear, that added issuance was expected in that the US Treasury was bound to start replenishing its coffers after the US debt ceiling ended in May. So at most, I think the Fitch downgrade came at an inconvenient time, although I would say any fallout from that downgrade alone should be limited and short-lived.
We saw something very similar happen in 2011 when Moody's downgraded US debt after a similar fight with fiscal hawks. Can markets take any guidance over what happened then?
Yeah, less so today compared to back then, right? Because back then, that downgrade by S&P, I believe, that was the initial shocker that came on the heels of the global financial crisis. This was back in August 2011. But even that sell-off that commenced after that downgrade in 2011 was unwound within just 6 months, right? So I think in today's context, investors today have got other and perhaps bigger worries to contend with. For example, when will the Fed actually stop hiking interest rates, and what's the likelihood of a global recession? I think that outlook will be more pertinent for global markets over the near term.
Markets are also awaiting the Bank of England's interest rate decision later today. What can we expect there?
Yeah, so as things stand, markets are expecting a 25 basis point hike by the Bank of England, although there could be a surprise larger than expected 50 basis point hike by the Bank of England. But overall, when it comes to these major central bankers, the primary question that investors have is how much higher do their respective interest rates have to go? So I think any signals that point to that fact as to when the Bank of England could be done with hiking interest rates, and given the current state of the UK economy and the trajectory for inflation, I think the signals to those questions could really rock the pound as well as UK assets.
Right, Han Tan there in Abu Dhabi. Thank you for your insights.
Thanks for having me.
Now to other top stories from around the world. China's Evergrande property services arm has lost almost half of its stock value, resuming trading after a 16-month pause. The stock lost $1.5 billion in market value as investors dumped around 330 million shares. The firm has been dragged into financial troubles after its parent company, China Evergrande Group, became entangled in a debt crisis in mid-2021. Brazil's central bank has slashed its benchmark interest rate by a larger than expected 50 basis points as inflation continues to ease. The Selic policy rate had been held steady at 13.75% since September, following a surprisingly aggressive tightening campaign that added 11.75% of hikes. President Lula da Silva has repeatedly criticized the central bank for high borrowing costs amid cooling inflation. And in Australia, office vacancies have climbed to the highest levels since the 1990s. The National Central Business District vacancy rate rose 12.8% in the first half of this year. The lack of demand for these spaces is due to the increase in remote working and higher rent as the central bank continues to increase interest rates.